Okay. So there we are. SEC required filings. Okay. Stock Exchange Commission required filings. Form S1. So this is the registration statement filed. That means they have to register the company, right? So they will file the registration statement under this form before the sale of new securities. So before, see, whenever a company has to start start its operations, whenever a company has to start its own operations, it has to get itself registered, right? And if they want to raise funds and issue new securities in the market, they have to get themselves registered. So they have to register like through form 1. They are kind of filing their registration statement or sharing their details to the regulators. That means you have to share your details for getting yourself registered. So under form 1 they're going to do that, and they have to do this prerequisite thing before issuing any securities to public. The statement includes disclosures about the securities offered. So statement includes all the disclosures and details about the securities what they are going to offer to the people, about the audited financial statements plus interim accounts. Interim accounts is nothing but quarterly accounts or half yearly, semi-annually if the statement is filed more than 3 months after year end. Okay. Then about the risks what the company is exposed to. Okay. Underwriters identification, whoever are the ones who are going to underwrite the shares of the company or provide the necessary last moment capital to the company for fulfilling their minimum subscription which is required to start the company, and the estimated amount and use of offering proceeds. Then they are going to then they are going to share certain details under form 10K. This is required annual filing that includes information about the business risks and its management. So this is the required annual filing, very much required one, that includes certain information about the businesses, what kind of business the company is doing, what kind of risk they have, and it's about the details about the management. Audited financial statements and disclosures about legal matters involving the firm, any litigation they are involved into, or anyone has filed any complaint, anyone has filed any kind of case against them. Information required in form 10K is similar to that which is similar to that which a firm typically provides in its annual report to shareholders. So information required in form 10K. Okay. Any information which is required in form 10K is similar to that which a firm typically provides in its annual report. But even then, don't think that if they are providing all the information in form if they are providing everything in the annual report, they are not going to disclose those information in form 10K. No, annual report is not a substitute for the form 10K filing. They cannot say that once we have given all the information there, we are not going to give here. It is not going to work like that. They have to file under 10K, and also they have to release the annual reports. Equivalent stock exchange commission forms for foreign issuers in the US markets are form 40F for Canadian companies and form 20F for other foreign issuers. So form 10K is for American companies. The same kind of form for foreign issuers in the US market. There can be some Canadian companies who are operating in US and who have raised funds or finance in the United States. Those Canadian companies have to fill the form 40F and form 20F. If Infosys is registered in New York Stock Exchange, they are raising finance in US, so they have to fill the form 20F. Non-Canadian and non-US companies. Form 10Q. Q is for quarter. US firms are required to file their form quarterly with updated interim statements. Those are semi-annual or quarterly statements. But the difference between 10Q, see, audits happen at the end of the year. Okay, only at the end of the year external audits are happening. So form 10K, unlike form 10K, these statements do have to be audited. Okay, 10K is the form which is annual, right? but like, these are quarterly, so they need not be audited. Of course, audit is something which happens at the end of the year. There's a lot of cost involved in in audits, so that happens at the end of the year. And disclosures about certain events such as significant legal proceedings or changes in accounting policy have to be disclosed. Non-US companies are typically required to file the equivalent form 6K semi-annually. Okay, so there are certain non-US companies, they are also required to file the equivalent form, but that is only semi-annually, not quarterly, unlike for the US forms, which is quarterly. So it's form 6K. Form DEF 14A. When a company prepares a proxy statement for its shareholders before the annual meeting or other shareholder vote. So when a company prepares a proxy statement for its shareholders before the annual meeting or other shareholder vote, it also files the statement with the Stock Exchange Commission as Form DEF 14A. Okay. So when a company prepares a proxy statement, that means there are proxies who also kind of vote. Am I right? On behalf of the shareholders, because the shareholders give them the authorization for that. So when a company prepares a proxy statement for its shareholders before the annual meeting or other shareholder vote, it also files a statement with SEC as form DEF 14A. Okay. So what is that they are saying is proxy statement is prepared before the annual meeting or any of the shareholder votes. Fine. It also, along with this, they are going to file the statement regarding all these details with the form DEF 14A. Form 8K, companies must file this form to disclose material events, including any kind of important assets they have, like big spendings, like some assets they have purchased or some disposals they have made or changes in management or corporate governance or any matters related to its accountants, its financial statements or the markets in which its securities trade. Form 144. A company can issue securities to certain qualified buyers without registering the securities with the Stock Exchange Commission, but it must notify the Stock Exchange Commission that it intends to do so. So a company can issue securities to certain qualified buyers. Okay. Like qualified buyers are the ones who are qualified investors, like pension funds, like, in India we have LIC. They have like almost investments in almost all the topmost blue chip companies in India. 6 to 10% holdings they may have, and those are qualified buyers. Okay. Qualified investors, so those are the ones, like company can issue securities to those only. So if they get some big time like qualified buyers, 4 or 5 buyers are enough to provide them funding, so they have to uh, like show the details in form 144. Okay. So a company can issue securities to certain qualified buyers without registering the securities with SEC, but it must notify SEC that it intends to do so. Okay. So company can issue securities to these people. Okay. But for that they don't want to register themselves, maybe that can happen. Okay, but they have to notify that to SEC that they don't want to register themselves and they want to issue the form to issue the securities to qualified buyers or raise the funds by issuing securities to qualified buyers. Form 345 involve the beneficial ownership of securities by a company's officers and directors. So, like there are some officers and directors in the company who can have certain ownership, like in the company of some securities. They can hold some securities. So analysts can use these filings to learn about purchases and sales of company securities by corporate insiders. So yeah, many people would like to know how many stocks of the companies are held by the company's employees. Okay. Now, both US GAAP and IFRS require companies to report segment data. Segment data is nothing but a company may have different businesses or may have different like have different segments. Okay. So different subsidiaries, you can say, or different branches, anything. So that those details are also required to be disclosed. And but required disclosure items are only a subset of required disclosure of company as a whole. Nonetheless, an analyst can prepare a more detailed analysis and forecast by examining the performance of business or geographic segments separately. Just a second. Now, nonetheless, an analyst can prepare a more detailed analysis and forecast by examining performance of, see, what analyst does is they have to analyze the company's performance or its segments performance, whether the company is in one area and has segments in different geographical areas, and they have to completely analyze the performance of the company and come out with their report. So segment profit margins, asset utilization, that means how they are utilizing their asset to generate their turnovers, return on assets can be very useful in gaining a clear picture of firm's overall operations. So all these ratios give a very good idea about companies' utilization, efficient utilization of their resources. For forecasting, growth rates of segment revenues and profits can be used to estimate future sales and profits and to determine the changes in company characteristics over time. So see, it is like every segment have to be studied. All the segments doing well is good for the company's future. That means company may have good prospects in the future. Business segment, operating segment, is a portion of a larger company that accounts for more than 10% of company's revenues, assets, or income. That is what a business segment is regarded as. An operating segment should be distinguishable from company's other lines of businesses in terms of risk and return characteristics of the segment. Segments reported should account for a minimum of 75% of its external sales. Okay, so what they say, what is an operating segment? A very big company, okay, of the a very big company, let us consider, and some portion of that company, a portion of larger company that accounts for more than 10% of company's revenues, assets, or income. What we are saying, a portion of, let's say this is a very big company, and some portion of this company that accounts for more than 10% of company's revenues, assets, or income. Okay, so that is the operating segment. An operating segment should be different from the company's other lines of business in terms of risk and return characteristics of the segment. You should distinguish them. Segments reported should account for a minimum of 75% of firm's external sales. So all the sales, whatever the firm is doing, 75% of that external sales should be from their segments, okay, and 25% from the company, like where it is established, from there itself 25% of the sales can be considered. Now, and the following must be disclosed for each segment within the financial statement notes. So what under the footnotes you are going to disclose? Revenue, external and between the segments. See the segments, let's say there's a company A, it has two subsidiaries B and C. Revenues can be, B can sell to external customers, C can sell to external customers, but they can sell internally as well, between them as well. Okay, that also should be disclosed. Actually, intercompany transactions should be disclosed. Measure of profit or loss, measure of assets and liabilities, whatever the interest expenses they have, acquisitions of PP and intangibles, depreciation, amortization, other non-cash expenses, income tax expense, share of equity accounted investments, results. Geographic segments, you know, there are many companies who have segments, like they have given some examples here. Geographic segments are also identified when they meet the size criterion given previously, and the geographic unit has a business environment that is different from that of other segments or remainder of company's business. Let's say there's an example here in 2016 annual report, Boeing, you know, Boeing it belongs to United States, described its business segment as follows. So they are into various segments. Fine, they are into commercial airplanes, they are into defense, they are into military aircraft making. Boeing's you know, F-35 fighter, Falcon, I think F-18, all these are, I think, Boeing's aircrafts. They are into network and space systems. They are into global services and support. Boeing Capital is a finance division what they have. Okay, so all these are different segments and they have disclosed about them. Some are the ones in which they are kind of some businesses seem to be very similar, like aircrafts. I know commercial airplanes and military aircraft are both different things, but they are aircrafts. But Boeing Capital is a total different division. Maybe that is they have, because this Boeing Capital can finance the companies who want to buy their commercial airplanes, or they can act as a lessor for those clients. Fine. And then comes management commentary. This is what is management discussion and analysis, also known as management report. Operating and financial review or management discussion analysis is one of the most useful sections of an annual report. IFRS guidance recommends that management commentary address the nature of the business, management's objectives. So yeah, what is management commentary doing? Management commentary, first of all, it sees, it gives emphasis, and it also gives certain like details about the nature of the business, management's objectives, what they want to achieve, how has their past performance been, what are the performance measure used to know their performance, on what are the parameters they have achieved in the performance, and the company's relationship and with the and resources and risks what they are exposed to. Analysts must be aware that some parts of management commentary may be unaudited. Yeah, okay, not everything is audited, fine, only statements are audited, not every area is audited, some areas are not audited as well. For publicly held firms in United States, SEC requires management commentary to discuss trends and identify significant events and uncertainties that affect the firm's liquidity. Like what are the aspects that can have an impact on the liquidity of the company? Because if the liquidity of the company is not strong, then what happens? They may struggle for working capital requirements. There can be certain issues to run their business operations smoothly on daily basis. They may struggle for that. Then also uncertainties about the capital resources. Okay. And results of operations. Management must also discuss the following: how is the inflation affecting the prices of their product? Like if material, that means that definitely it should be material as well, because inflation matters. For like if there's a very high jump in the prices, then definitely that can be due to inflation factor, cannot be cannot be ignored. Because when you have today inquired about certain fees, if you want to take admission into certain college in US this year, let's say it is $10,000 for one semester, and next year when you go, they ask you to pay for $13,000 for semester. $3,000 jump is not a small jump; it's a very big jump, and that can be due to education and inflation, and that they justify, and that's what things become material when it can impact your decision making. Impact of balance sheet obligations. Off balance sheet obligations are nothing but certain, there are certain items which are off balance sheet, like like you know short term lease. There are two types of lease: short term lease and long term lease. Long term lease also called as capital lease. This is also called as operating lease. So operating lease is a off balance sheet item. Okay, need not to be shown in balance sheet. Okay, but definitely expenses are to be accounted in the P&L account, but this lease is not required to be shown in the balance sheet. And certain contractual obligations such as purchase commitments. This can also be very important aspect under the management commentary, management discussion and commentary. Every kind of aspect should be discussed with the analyst, or analyst must have a notice of. Accounting policies that require significant judgment by management. See, there are certain accounting policies which, of course, the if any kind of changes the company's accountants want to do, like they want to change the valuation method of inventory from LIFO to FIFO. Okay, and that is a change in accounting policy. Okay, and that can only be done if it is very significant, and if not done, then that can have an impact on company. How it can have an impact on company, see, without explaining these methods, I can't just explain you that right now. As these two methods have give different results with respect to valuation in inventory. So we will be discussing that in detail. Just a second. Yes. And then like these two methods have different kind of concepts. LIFO is last in first out, last what inventory comes you have to sell it first, and FIFO is first in first out, what inventory you have from the beginning you have to sell it first. During the inflationary times, when there is high inflation, LIFO COGS will be very high, okay, and FIFO COGS will be low. So there can be at times the accountants want to change the methods, and when that will happen, what is the case, we will discuss afterwards, okay, because it will take the discussion to somewhere else. Now, forward looking expenditures and diverse teachers, that means in future what kind of excessive expenditure the company can have, and also which segment is not like performing well or in losses. The company may the company may plan to sell that segment, okay, that's called diverse teacher, divesting, okay. So these kind of things also should be discussed. An audit is an important, see, companies have to get their statements audited by an external auditor, and that's a very important review. What the company, what the shareholders want, what the shareholders would always want the companies to encourage, okay, because audited statements are the ones which will be kind of an assurance for shareholders that everything in the company is fine. If there is a qualified opinion is bad opinion about the company. Non-qualified opinion is good opinion about the company. Yes, it would look to you like, is it so? Yes, qualified opinion given by the auditor is not a good opinion about the company. It's an adverse opinion, and non-qualified opinion is a good opinion. So the investors, if get non-qualified opinion, that means everything is all right in the company. Unqualified or non-qualified, I can say qualified is not good, unqualified is good opinion. So an audit is an independent review of companies. Yeah, independent because they are external people. They have no pressure from the company. Public accountants conduct audits and examine the financial reports and supporting records. Objective of an audit is to enable auditor to provide an opinion on the fairness and reliability of the financial statements, of course. That's what the task they have. Independent CPA firm like Deloitte, KPMG, and Ernst & Young, employed by the board of directors, is responsible for seeing that the financial statements conform to the applicable accounting standards. First and foremost things, without standards, the statements have no authenticity. Auditor examines the company's accounting and internal control systems, confirms assets and liabilities, what are shown in the books are really existing or not, and generally tries to determine that there are no material errors in the financial statements. Auditor's report is an important source of information. The standard auditor's opinion contains 3 parts and states the following. Now you understand. So what is an auditor's opinion like? Whereas the financial statements are prepared by the management and are its responsibility, the auditor has performed an independent review. So the statements are prepared by the management, of course, and they have to make sure that the auditors do a independent review of the statements what they have prepared. Generally accepted auditing standards are followed. Yes, we have audit standards as well, thus providing reasonable assurance. Assurance is nothing but giving the confidence that financial statements contain no material errors, because they work based upon their audit standards and they have to ensure that everything is all right. So their assurance is like a confidence, right? It gives confidence to the investors. The auditor is satisfied that the statements are prepared in accordance with the accepted accounting principles and the principles chosen and estimates made are reasonable. That means based according to standards only. Auditor's report must also contain additional explanation when accounting methods have not been consistently between periods. That means wherever they have element of doubt, they can investigate. It's a big chapter, my God. Now, and then comes the unqualified opinion. Indicates that auditor believes the statements are free from material omissions or errors. That means there is no error and nothing has been omitted. It is free from any kind of errors and omissions. Qualified opinion is not good. So that is a matter of concern, and company's internal control should also be very intact. That an auditor of the company should give a statement about the internal controls of the company. Internal controls are nothing but the internal audit department, whose head is like the audit director, because there is an audit committee which is responsible for conducting internal audits in the company, which is headed by the director who has a very good knowledge about the audit, audit engagements. Okay, because the knowledge and experience of an audit director is very essential for like running the audit committee. Okay, and publicly traded firms in United States, the auditor must express opinion on firms internal controls. I have already explained you that one. And then comes the next point. Yeah, certain differences you should understand what these two standards have, IFRS and US GAAP. So basis of comparison, US GAAP is prepared by FASB board, IFRS is prepared by IASB board. Yesterday I have explained everything to you. Rule based, principle based, inventory valuation. Here all the three methods you can use: FIFO, LIFO, AFCO, weighted average. LIFO is prohibited. I'll give you the reason why. They think that during inflationary times, when there is very high inflation in the market, last in first out, last whatever you buy and you sell first, the COGS will be very high during those times. And what companies can do is they can use this as a tool to like unnecessarily reduce their taxes. See, tax reduction is not a bad thing. Government gives you a lot of opportunity and chances, and also certain expenses which you can use as deduction to reduce your taxes. But this as a tool to reduce taxes is not good, because there they can use FIFO as well, which is not impacted or affected due to inflation. So here what happens, when the COGS is very high, the net profit will be less and the taxes will be less, of course. So they kind of take advantage. So IFRS is of the opinion that this should not be considered in the accounting treatment related to inventory valuation. Product development cost, here development cost is expense, here it is capitalized at times. Okay, but to capitalize development cost, that means research and development cost they are speaking about. As per IFRS, research is an expense and development is a intangible asset, or should be capitalized. Why? Because if this can kind of give economic benefits in the future, then that matches with the definition of an asset, hence can be shown as an asset. Okay, here it is very clear, rule based system, they always want this to expense. Interest paid, I already explained yesterday, only in operating and financing. Reversal of inventory write downs, that means inventory value can go up. Okay, okay, that's okay. Inventory value goes down, okay, can go down, that's okay. But from down to up, if it goes, like once inventory value has gone very down and again it has gone up, like $100 inventory has almost become obsolete to $30, and you immediately find a buyer who is ready to give you $150 for this. That means for them it is very important. If you can get someone in market of such kind of people, if you can get in the market, you're getting a very good gain, right? Almost $120. So IFRS allows the upward reversal, but here upward reversal is not allowed. Only the downward only the losses can be shown in this case. Okay, that means upward reversal is not allowed in US GAAP. Understood, Bhargav? Hello, Bhargav, did you understand?
Yeah, sure.
Yeah, upward reversal are not allowed in US GAAP. Only IFRS allows that if you can find some buyer in that case. Now, so these are the differences. I already explained you, differences can be there. There are two different school of thought, but the aim is to kind of give you the best results with the use with respect to usage of standards, to make your task easier, and updates, amendments happen, and according to the standards also they update themselves. Describe information sources that analysts use in financial statement analysis besides annual and interim financial reports. See, these are the valid sources. From there they get all, from where they get all the information about company's performance. Apart from that, they get certain information from different sources, reliable sources, like Issuer sources, companies, earnings calls targeted at investors, analysts, and members of media. Earnings call include presentation of company's management and opportunity for question and answer sessions. That means whatever has people asked or questionnaires and all, this kind of data they can get. Firms often provide earnings guidance. Okay. The management accountants of the company, they give guidance to the company regarding how they can improve their performance. So such kind of data also can be like, procured and can be, used for analysis purpose. An earnings announcement, that means what they are going to declare, dividends, etc. Senior management may hold a conference call to answer questions and provide information to complement their regulatory filings. Ad hoc, that means this is made for certain, for certain like task or like, ad hoc teams, ad hoc presentations are meant for a particular purpose. So ad hoc presentations and events that are similar in format to an earnings call. Press releases focusing on major events relevant to company. That means what company is going to get a new project or some kind of debts they have paid, repaid, or some kind of news can create a good perception amongst the investors. Communication with management, investor relations, and company personnel. Analysts should note that these additional sources of information provided by issuers are unlikely to have been audited, because what they tell have to be believed. Then some third party sources, if it is audited, then definitely that is more trustworthy or more assured or more confidence providing one. But since everything cannot be audited, some things can, there is also some word called trust. Okay. Then public third party sources, free industry reports, white papers, trade journals, government related reports, like generalized and industry specific media resources, social media. And then comes proprietary third party sources, analyst reports, like Bloomberg, FactSet. These are all the ones who have done very thorough research about companies' performance. And certain agencies, proprietary primary studies commissioned by analysts, hands-on experience with companies' products or services, data and advice of technical specialists employed by the analyst. All these are also certain very good valid sources of information regarding a company, and analysts can study all this and review all this and can prepare their report for the betterment of the investor, so that investors money is not going into wrong hands. Okay, this is what is the chapter we have finished. Bhargav, what do you say? We shall go for new topic, or shall we take it tomorrow afresh?
Whatever is fine. I guess tomorrow would be better.
Yeah, see, for me, no problem. Just asking, like, if it is like I told now, the reason, like there was a power cut, so 10-15 minutes I had no other option, was waiting. So tomorrow, analyzing balance sheets we can go for. Okay. Hello.
Okay, sir.
Yeah, so tomorrow, like I'll be coming a bit early, Bhargav, to home. What time will be available?
Sir, I'll be available after 6, sir. 6:30.
After 6:30. Okay. Tomorrow is my daughter's birthday, so I thought of coming early and taking. Okay, we will see.
Oh, okay. Okay.
No, no worries. We'll see. We'll take the class. Let us
Yes.
check how it goes. Like if it's possible in the early in the evening, we'll try to take from 6 o'clock. You're saying, right? 6.
Yeah, or else, sir, as soon as I come back home, I'll text you.
Yeah, do that. Okay. So
Okay.
I shall send you this 29th reading questions, right?
Um, Sir, we did 29 right now.
Sorry.
Yes,
Yeah,
sir.
we
You
finished. We
have to
finished.
send that.
I shall send the PDF
Yes.
of this, right? I'm saying.
Yes, sir.
Okay, I'll do that within some time. Okay, Bhargav.
Yes, sir.
Okay then. Okay. Thank you.